The hard part is for the people at the bottom, it's not good. It's really not good. For the people at the top, they don't really care. They're good. The people in the upper half, they'll be fine. It is really hard for the people at the bottom. And look, we've all seen pictures of the Great Depression, the bread lines and the Dust Bowl. And for the people at the bottom, it's super hard. But, and if you look at the pictures of London in the 1860s, right? The people at the bottom, the Tiny Tims and the Christmas Carol story and all that, it's hard. But the country moves forward and moves on.
Recent Treasury bond auctions have experienced a notable drop in investor demand, a trend that could potentially lead to higher yields, according to strategists. During a recent $20 billion auction of 30-year bonds in the United States, dealers had to absorb 18% of the sales, exceeding the typical 11% share. This follows a series of lackluster auctions for 3-year and 10-year treasuries earlier in the week. Concurrently, concerns about a looming U.S. debt crisis, which has been a driving factor behind the sharp sell-off in treasuries since August, are viewed as a legitimate worry. In the perspective of Mark Yusko, rising yields are the result of activist traders, known as bond vigilantes, striving to push interest rates to levels that would compel the U.S. government to address mounting deficits and debt. If left unaddressed, these fiscal challenges may reach a tipping point that could potentially lead to some form of U.S. default. Mark Yusko expresses his thoughts on this complex issue, emphasizing the growing risks associated with the current trajectory of Treasury bond auctions and rising yields.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I think inflation has peaked. I think we're heading back down with one caveat. If this skirmish, and again, I don't mean to your point earlier, prayers and hope for all the people impacted by this. I can't imagine what's going on and having to move and flee from bombs. And I can't imagine. I've never experienced that. So I'm not trying to minimize, but right now it's a localized, well, it's fine. We'll call it a war. It's not a skirmish. It's a war. It's a full-fledged war, but it's in a small area. But if it expands to the region, oil prices go up a lot, like a lot. And if that happens, inflation short-term goes up and economic growth comes crashing down. And in that scenario, I think your point on Janet loses control and she gets stuck trying to thread that needle and people call bullshit. And we're at 6% on the long end in 5 heartbeats. So, there was a guy literally, I think right after we recorded the show, said, I'm all in long bonds, 84.04 on the TLT. Damn, that's brave. And he's been right? It's up 3.5%. That was a good trade. Most people believe, and I think that's why wars are started, that war's good for the economy. It's good for stocks and it's good for GDP growth. Well, it definitely is good for defense companies. It's definitely good for auxiliary businesses that support the war effort. And historically, it has been good for GDP growth. And historically, it actually has been good for the stock market. I fear in this case, where an expanded Middle East conflict would have such a deleterious effect on oil in a time where oil's still really important and where, we don't have the strategic petroleum reserve and all kinds of other challenges. I just think it would catch people off sides. And I think we'd end up with a 2022 kind of redo. I could see a down 20% in equities easy. You'd lose at least that in your long bonds. Maybe actually you'd probably lose more like 30%. And it'd be ugly. And the other problem is liquidity dries up, right? Because you got this commitment, to shrink the balance sheet. Well, I think they'd have to throw that out the window. I do. Because at the end of the day, there are no buyers. So the buyer last resort has to be the central bank. And that, my friend, is what Paul Tudor Jones said. That'd be good for gold and good for Bitcoin. And I love how I said, I like Bitcoin. It just doesn't matter. No
Right.
one borrows at Fed funds. Like the average car loan, which is a crazy stat, it's like 17%. It's like, no, there's all these zero loans. I'm like, yeah, rich people get zero, but the average person is not getting zero rates. I mean, they're paying double. I heard car loans can go all the way up to 29%. Holy shit, that's like a credit. We have currency devaluation, right? That's what we have. We created way too much currency, and the Fed's trying to fix that. I actually give credit to Jerome Powell, who might be the only person who isn't in the bad actor group. Right?
I feel like he's deserved
he
credit this whole
literally
time.
is independent. I think he means well. I think he's not part of the BlackRock, Goldman, Treasury secretary, like billions cast. I think and you saw it. He's trying to run off the balance sheet. He's trying to. He got M2 negative for the first time in 100 years because he realizes Kelton was wrong. Right? You cannot create unlimited money with no impact. That was never a good idea. That was Krugman-esque. That was not smart. And I applaud them. But it did create currency devaluation. And it meant the price of everything that people need, housing, shelter, food, transportation, went up a lot. Not because those things got better, because the money got worse. And to your point, what is the only response when things get really ugly? Print more money, right? That's the only way out. And I mean, and it's just the law of large numbers, right? We created $500 billion in national debt in the last, 3 months? $500 billion? I mean, and someone put up, it like took, I don't know what it was, 100 years to get the first $500 billion. And then we did $500 billion in 3 months. I mean, the only thing that makes me feel good about that is the opportunity in data, where I think we talked about this last week, right? That from the beginning of time to 2003, 5 exabytes of data were created.
For those who are new to financial terminology, it's important to understand that treasuries and bonds are both categories of debt securities that organizations issue to secure capital. Here's a concise overview. Treasuries are issued by the government, particularly the U.S. Department of the Treasury. In the case of the United States, they are widely regarded as one of the safest investment options due to their backing by the full faith and credit of the U.S. government. Common types include Treasury bills, which are short-term, Treasury notes, for medium-term, and Treasury bonds for long-term investments. On the other hand, bonds are a general term for debt securities where the issuer borrows funds from bondholders and commits to repaying the principal amount at a specified maturity date, along with periodic interest payments. Bonds can be issued by various entities, including governments, municipalities, and corporations. The safety and interest rates associated with bonds can vary significantly, contingent on the issuer's creditworthiness. Both treasuries and bonds serve as instruments for issuers to fund projects or operations, while investors utilize them to earn interest and potentially gain from price appreciation. Now, let's return to the video as Mark Yusko offers further insights into future projections.
Long-term is going to be the issue that there's not enough buyers, and there's this really interesting problem. So we've alienated our formerly largest buyers of treasuries. The Russians, the Chinese, Japanese, even the Germans and the French, and pretty much pissed off everybody, Saudis. And so who's going to replace that? Here's a crazy thing. If it weren't for Tether and Circle that own $90 billion of treasuries, rates would be in really significant pain right now. And so, and I think the point you said that Andy and the guys were making was that the mix of short duration to long duration is really important, right? Because if you have too much short duration, you're forced to refinance more often, obviously. And if you have to refinance into rising rates, that causes a death spiral. And, what's really odd is we had 0 interest rates on the short end and kind of 2-3% on the long end for a decade almost. Wouldn't you, if you were really prudent, have hit that bid and pushed them all to the long end? Like issued all 30, 40, 50, 100-year bonds? Why weren't we issuing 100-year bonds? But no, we kept issuing T-bills. And I think we're at the highest level, is that right? The highest level of T-bills to T-bonds in history?
The surge in U.S. government bond yields over the past 6 months can be attributed to a straightforward reality. The 2 largest players in the market, China and the Federal Reserve, have curtailed their buying activities. In recent decades, both China and the Fed amassed trillions of dollars worth of U.S. Treasury bonds to finance significant deficits stemming from the 2008 financial crisis and the COVID-19 pandemic. However, the Federal Reserve has reduced its holdings of U.S. Treasury bonds by $650 billion over the past year, and China's official holdings have declined by more than $50 billion during the same period, with a total drop of nearly $300 billion since early 2021. The Federal Reserve isn't actively selling U.S. Treasuries. Instead, it's allowing them to mature and roll off the balance sheet without reinvesting in new bonds. However, data on China's holdings have limitations, and some experts suggest that they may be relatively flat rather than declining. Nevertheless, it is evident that both the Fed and China are not the robust buyers they once were. China initially became a major buyer of U.S. government bonds approximately 2 decades ago, using these purchases to prevent its currency from appreciating, which aided its exports sector. Presently, the economic landscape has evolved. The U.S. experiences low unemployment and inflation concerns, leading the Fed to reduce its government bond holdings. In China, economic challenges and a weakening currency have prompted them to possibly sell some of their treasuries in an effort to stabilize their currency. The deteriorating relationship between the U.S. and China, as well as America's sanctions on Russia following its invasion of Ukraine, may also be motivating China to reduce its exposure to the U.S. financial system. While the absence of buying interest from the Fed and Chinese buyers is not the sole factor influencing the recent rise in bond yields, it is part of a broader equation that includes increased supply, market perceptions of economic growth, inflation, and Fed policy. These factors collectively point to a higher for longer scenario, which poses challenges in managing U.S. debt, now at nearly 100% of GDP. Given the changing roles of the U.S. and China in the global bond market and the potential global economic ramifications, it raises questions about the unforeseen challenges and opportunities for international investors and economies in the coming years. Share your thoughts in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.